Okay, welcome to Exit Value. I'm Justin Levine. It's November, early November, beautiful weather outside. About 6 weeks since I posted my last blog, I have been hectically busy. One of the key topics that's been top of my mind over the past few weeks with a lot of clients has been the concept of business valuation. Now, some of you watching this will go, hey, I know how to value a business, but do you know a lot of people don't? So I thought I'd post a few hints and tips about how you go about valuing a business. Okay, right from the outset, this is a big topic. I could write a book, or indeed have read many books about the concepts of business valuation, so we're going to condense a lot of stuff down into 2 or 3 minutes. So, first off, business valuation. There's about 5 different techniques you can use to value a business. Sometimes you mix them up, but in my personal experience, the most common way of valuing a business is by coming up with a value based on a multiple of adjusted profits. And that has some common sense if you think about it. If a business is making, say, 1 million every year in terms of profits, you as an investor might say, listen, I might buy that business and after 4 years, I want to start seeing some money back. So I'm prepared to buy it for 4 million, but after that time, I want to see some money coming back. So there's a bit of common sense in that kind of valuation. In the real world, we actually come up and use a phrase called EBITDA. Some people say EBITDA, I say EBITDA. EBITDA is earnings before interest, tax, depreciation and amortization. So try saying that after a couple of glasses of wine. Not easy. Again, some of you will know this, but for those of you that don't know what EBITDA really does and means, it's actually relatively straightforward to explain. If my accountant was here, we could do it even better, but here we go. So most of you are familiar, I guess, with a profit statement of a business. Typically, you will have sales revenue, you'll have some costs of goods or costs of service, then you'll have some overhead costs, and then eventually you'll have an operating profit or net profit number before you pay your corporation taxes. Keep that in mind, that net profit or operating profit number. EBITDA has some similarities to that because it's based from that number. We take our operating profit and very simply we add back the depreciation charge that's shown in that profit statement. So typically your accountant, when he's shown that operating profit, he'll have already charged some depreciation to your overheads and indeed will have probably put the interest charges you pay on any debt that you've got, long-term loans, short-term loans, HP and so on, or indeed if you're making any cash, any interest from cash in the bank, that will also be charged. So the long and short of it, EBITDA is your operating profit number, adding back depreciation, adding back amortization, and adding back the net difference on any interest that you have paid. Okay, so it's operating profit and adding back those differences. And that gives us our EBITDA number. Now, when you're selling a business, one of the key things to value a business is you take your EBITDA number, which is a number that is just a straightforward, logically derived set of numbers from your profit and loss statement, and your accountant can help you do that. And you must adjust any disproportionate costs that you as an owner actually sort of take out of the business. That's not unusual. We call it owner benefits. Lots of people that own businesses put in costs, legitimate costs I might say, into their business, which as a buyer, those costs might not be there. So you've got to say, listen, this was the EBITDA, this was the profit we were making, but you know something, I was taking a little bit more than, my salary was a little bit more than would be normal market rate. So you add that back on top any differences. In other words, you come up with an adjusted EBITDA number, a number that looks that when a buyer is going to buy that number, they should expect that level of profitability in the business. So there you go. We've suddenly built our first pillar of the valuation, which is our adjusted EBITDA number. And the key thing is you've got to do it not only for the current year you're running, but also the previous couple of years, because a buyer is going to want to see the history of the profit in the business. So there we go. We got our foundation. Of course, the key question you're asking me, or going to ask, I guess, is, well, what is the multiple that you will apply to that number to come up with a valuation? Well, that is the million-dollar question. There are some guidelines you can get, and of course if you go and Google it, and please do, go Google average business valuations, what you'll find is that there are some sort of generic numbers per industry segment that give you an idea of the kind of average multiple. But I stress, that's a guideline. Don't take those things verbatim or verbatim, not sure which one that is. So, for example, if you pick up an accountancy book and see business valuation, do you know, I've read, maybe 30 accountancy books and I've seen an average of 3 to 6 times earnings, 3 to 6 times EBITDA has been kind of the standard to sell a business. Well, I got to tell you, that's a very broad brush because I've seen businesses sell for 8, 10, 12, sometimes higher times EBITDA. companies in the biotech space, companies in the technology space. You know, some of these can really command a premium because the people want to buy those companies for various different reasons. Scalable businesses can be very valuable. Businesses in the luxury sector can be very valuable. So this kind of multiple of earnings, multiple of EBITDA, that number obviously is a very key number. If you sell a business for 4 times earnings or 14 times earnings, massive difference. Okay, the answer is on a video like this. I can't say that if you're running, let's say, a retail company, I can't give you a number, but a professional valuer should be able to give you some idea, an indicative number of the kind of value of your business. Of course, the last thing is always keep that as being a fairly loose number, because if a business is sold particularly well, that number can get higher. I'll explain that more in another blog. But there you go. There's the basis for valuing a business, is multiple of EBITDA typically gives you a valuation. The final question, just to leave you with it, is I was asked by a client recently saying, okay, and in this particular case, his business was worth about 6 to 7 times EBITDA, which was all good. The client said to me, listen, but what about all of my stocks that I have? I've got about £1 million worth of stocks. I've got a decent debtor book. Will the buyer pay more for those things? In other words, will they buy those things on top of that multiple of EBITDA? And the answer is typically no. Because of course, those things in the background, your debtor book, your stocks, those are the engines that are used to create that profit. So a buyer's not going to double account for that stuff and buy that. Not always the rule, but generally. So I hope that's of some help for the 25% of you that I guess watched this all the way through, maybe added a little bit of extra knowledge. Thank you for stopping by, and next blog coming soon. Bye now.